Welcome, Stock Explorers. Today, we're diving deep into Zeta Global Holdings Corp. This is a company right at the forefront of AI-powered marketing.
Exactly. But it's also got this, let's say, interesting valuation story that's had a lot of investors scratching their heads.
Right. So our mission today is to really unpack Zeta Global. We'll look at the tech, the financials, the whole picture.
We want to explore what makes it such a compelling growth engine, but also, frankly, the challenges it faces.
Because what's fascinating here, as you said, is that Zeta keeps beating expectations, right? A classic high-growth tech story in many ways.
Yeah, consistently beating and raising. Yet the market valuation, well, it hasn't always reflected that performance.
Yeah.
So we'll dig into why that disconnect might exist and, what that means for anyone trying to understand this company.
Precisely. You're going to get a comprehensive view from the AI they're building to the balance sheet, understand the real potential and the risks. Okay, let's get into it.
Let's do it.
So starting at the beginning.
Yeah.
At its heart, what exactly does Zeta Global do?
Okay, so Zeta's core offering is the Zeta Marketing Platform, the ZMP. Think of it as this all-in-one AI-powered marketing cloud.
All in one.
Yeah, designed to simplify really complex marketing tasks, especially for big enterprise clients. It basically unifies three key things.
All right.
First, identity. That's about getting a single, persistent view of a consumer across all their different devices, seeing the whole person.
Right.
Then there's intelligence, analyzing all that data to figure out what a consumer might do next and suggesting the best action for the marketer.
Predicting intent.
Exactly. And finally, activation. Taking that intelligence and delivering personalized messages across, well, pretty much every channel, email, websites, connected TV, you name it.
And a big differentiator here, I gather, is their own data.
Yeah.
Right? Not just using other people's data.
Absolutely. That's crucial. The ZMP is built on what they call the Zeta Identity Graph.
Identity graph.
Yeah, it's this huge proprietary database. We're talking permission profiles of over 245 million U.S. consumers.
Wow, permission.
Right. And it's enriched by literally trillions of behavioral signals. Yeah. So in a world where data privacy rules are getting tighter and those third-party cookies are, going away.
Going way fast.
Owning this kind of first-party permission data is a massive advantage. It's durable. It's a real competitive moat.
Okay, that makes sense. Now, this is where it gets really interesting for me, their innovation, especially the AI side. They're making some big moves there.
They really are. Two initiatives kind of stand out right now. First is Zeta Answers and agentic marketing. They launched this recently.
Zeta Answers.
Yeah, it's an AI intelligence framework, but it's designed to deliver marketing outcomes, not just, more charts and data.
Outcomes, not just insights.
Exactly. It gives prescriptive recommendations. It automates complex tasks all by itself. The big idea is this shift towards agentic marketing.
Agentic marketing.
Meaning AI agents that can analyze, predict, and critically act to optimize campaigns in real time. CEO David Steinberg said CMOs don't need more dashboards. They need decisions.
Yeah, I can see that.
And the proof seems to be in the pudding. Early users are reporting something like a 30% jump in engagement.
Okay, 30% is significant. And the other initiative, you mentioned too.
Right. The second one is the AI Agent Studio. This rolled out in Q1 of 2025.
Agent Studio. So building on the agentic idea.
Precisely. It's a suite of generative AI tools. Marketers can use pre-built AI agents or even create their own custom ones for multi-step marketing workflows.
Okay.
But here's the really compelling part, the monetization piece. Clients who are adopting these advanced AI capabilities, they're seeing revenue growth of over 40% year over year with Zeta.
Whoa, 40% compared to...
Compared to their other customers. It significantly outpaces them. So it really highlights how fast these AI solutions are being adopted and monetized. It shows the AI investment is paying off quickly and driving real value.
That's a very clear link between the tech and the revenue growth.
Yeah. Right.
So what does this all mean for their sort of longer-term vision? Where are they heading?
Well, it ties directly into this ambitious plan they unveiled back in February 2025, the Zeta 2028 strategic plan.
Zeta 2028. Okay, sounds big.
It is. They've set some pretty clear targets. Revenue over $2.1 billion by 2028.
$2.1 billion.
Yeah, which implies, a sustained 20% organic compound annual growth rate starting from 2024.
Okay, strong growth. What about profit?
They're targeting adjusted EBITDA over $525 million. That points to pretty significant margin expansion, getting over 25%.
25% margin. That's healthy.
Very healthy. And free cash flow, they're aiming for over $340 million. That's targeting like a 65% conversion rate from that adjusted EBITDA figure.
So strong cash generation too.
Absolutely. And this whole plan, it signals management's confidence that they can hit what's called the Rule of 60.
Ah, yes. The rule of 60. Remind us what that is.
Sure. It's basically where your revenue growth rate plus your adjusted EBITDA margin add up to 60 or more. It's a key benchmark for top-tier SaaS companies.
Signaling efficient, profitable growth.
Exactly. The fact that they're publicly aiming for this really underscores their conviction in moving towards sustainable profitability. That could be a real game changer for how the market values them.
So it's not just growth for growth's sake.
Mm-hmm.
It's profitable growth.
Yeah.
How are they actually getting these customers to fuel this plan? Is it all about landing new big names?
It's more of a land and expand strategy, really focused on large enterprise clients. So they land a client maybe with one solution, and then they expand that relationship, selling more services over time. And the numbers show it's working.
Okay.
They're scaled customers. These are the ones spending over $100,000 a year.
Yeah.
They grew 19% year over year in Q1 25, up to 548.
Almost 550 of those?
Yeah. And even more impressive are the super scaled customers, spending over $1 million annually.
The whales.
Right. They increased 10% year over year to 159.
Okay.
And critically, the average revenue per user, or ARPU, is climbing steadily too. That shows the cross-selling is working.
They're spending more over time.
Exactly. Quarterly scaled customer ARPU was up 12% year over year to $467,000. And for the super scaled ones, ARPU surged 23% year over year to almost $1.4 million.
Wow, $1.38 million average. That's serious expansion.
It is, and that expansion within the existing base is a really powerful driver of predictable, high-quality revenue.
Okay, let's talk numbers then. Because Zeta, as we mentioned, has this remarkable financial track record, 15 quarters straight of beating expectations. That's unusual.
That's quite impressive, yeah. That kind of consistency, beating and raising their own guidance for almost 4 years. It's highly unusual in the tech world, really speaks to their execution.
So what did Q1 2025 look like specifically? Give us the highlights.
Okay, Q1 25. Revenue came in at $264 million. That's a strong 36% increase year over year, and it comfortably beat analyst estimates.
36% growth, still very strong.
Yeah. Adjusted EBITDA grew even faster at an impressive 53% year over year to $46.7 million.
53%.
And the margin expanded nicely, too, by 200 basis points. So 2 full percentage points up to 17.7%. That really shows strong operating leverage kicking in.
Okay, margin expansion is key. What about cash flow?
That was a really notable bright spot. Free cash flow surged 87% year over year to $28 million.
87%.
Yeah. And the conversion of adjusted EBITDA into free cash flow was a healthy 60%. So it shows they're getting more efficient at turning that adjusted profit into actual cash, improving capital efficiency.
And that cash flow generation looks fantastic, especially for a company still growing this fast. But, and there's always a but, isn't there? When we talk profitability, there's this GAAP versus non-GAAP thing that always comes up.
Yes, and that brings us to a really key point of debate. Under standard accounting rules, GAAP generally accepted accounting principles, the company reported a net loss of $22 million in Q1 2025.
Still a loss on a GAAP basis.
Right. Now, that's an improvement from the year before, but this GAAP loss contrasts sharply with those strong adjusted EBITDA and free cash flow figures.
And why the difference? Usually stock-based compensation, right?
That's often the main driver, yes. Non-cash expenses like stock-based comp can create this gap between GAAP net income and adjusted figures. And it's a major point of discussion, even contention for investors. Creates a kind of perceived disconnect.
Okay, we'll definitely need to circle back to that stock comp issue. But first, what about their outlook for the rest of 2025?
Yeah.
Given this history of beating and raising, are they guiding aggressively now?
Well, they did raise their full fiscal year 2025 guidance again after Q1. But interestingly, management characterized the new guidance as disciplined and conservative.
Conservative, even after that strong Q1.
Yeah. They're now guiding for revenue at a midpoint of $1.242 billion. That's about 23% year-over-year growth.
Still solid growth, but a deceleration from 36%.
Right. Adjusted EBITDA midpoint is $258.5 million, roughly 34% year-over-year growth, pushing the margin towards 21%.
Okay, continued margin expansion.
And free cash flow midpoint $131.5 million, about 43% year-over-year growth. So still strong growth across the board.
But they're calling it conservative.
Yeah.
Why?
They cited potential macroeconomic and policy uncertainty for the second half of the year. Even though they said they aren't seeing direct evidence of slowdowns in their business yet, they're building in some caution.
Okay, managing expectations. So let's try and look this all together. We have this high-growth company, strong operational metrics, accelerating margin, improving free cash flow.
15 quarters of beat and raise.
Right, so why then is its stock valuation still such a puzzle? Why the discount compared to peers?
That really is the core riddle, isn't it? Despite hitting that impressive growth, despite performing at or near that Rule of 60 level, Zeta trades at a significant discount.
How significant are we talking?
Well, think about this. Based on their 2025 guidance, their forward price-to-sales ratio is around 2.9 times.
2.9, okay.
Now, compare that to some of the marketing tech giants, maybe like Adobe or Salesforce. Zeta's growing much faster, yet it trades at a fraction of their multiples.
So the market just isn't giving them credit for the growth?
It seems like it. It's almost like the market is still laser-focused on those historical gap losses, maybe that stock-based comp issue we mentioned, or perhaps there's still an overhang from past controversies. It feels like they're overlooking the fundamental growth story to some extent.
Okay, so let's break down the two sides of that argument. Let's start with the bull case. What gets investors really excited about Zeta Global?
Right, the bull case. I think it rests on three main pillars. First, obviously, sustained growth. You see that 36% jump in Q1 revenue. You look at the Zeta 2028 plan targeting 20% organic key GR. The momentum is clearly there.
Pillar 1.
Growth.
Pillar 2. Compelling valuation. As we just discussed, that enterprise value to sales multiple is just way lower than slower growing competitors. That signals real potential for a re-rating if sentiment shifts.
Undervalued relative to peers in its own growth.
Exactly. And pillar 3, the differentiated technology moat. The ZMP, fueled by that unique identity graph and those cutting-edge AI tools like Zeta Answers and the AI Agent Studio, it's clearly working.
Winning big clients, winning large enterprise clients, driving that strong ARPU growth, and critically, showing impressive monetization from those AI tools. That innovation is translating directly into customer value and dollars for Zeta.
And wasn't there also talk about potential M&A interest? That often puts a floor under a stock price.
Good point.
Yeah.
Yes, during the Q1 2025 earnings call, CEO David Steinberg actually confirmed that Zeta has received takeover interest for the entire company.
He confirmed it publicly.
He did. Now, obviously, that doesn't mean a deal is imminent, but it's not just idle speculation. It validates Zeta as a genuinely attractive M&A target for bigger tech players.
Right. And that possibility could provide a sort of strategic floor for the stock's valuation, maybe offer a nice premium down the line.
Potentially, yes. It adds another layer to the bull thesis.
Okay, now for the other side of the coin, the bear case. What are the big risks? What keeps investors up at night when they look at Zeta?
All right, the bear case. It definitely has some tangible financial and reputational risks. The biggest financial one is that lack of GAAP profitability combined with high stock-based compensation, SBC.
Back to the GAAP loss in SBC.
Exactly. Those persistent GAAP net losses, like the nearly $70 million loss they posted for the full fiscal year 2024, they're largely driven by that high SBC.
How high are we talking for this year?
They've guided SBC to be around $190 million for 2025. Now, that's a lot of non-cash expense, and critically, it dilutes existing shareholders.
Dilution is a key concern.
For sure. Bears argue, quite reasonably, that until Zeta shows sustainable GAAP profitability, the current valuation, even discounted, might not be fully justified. They want to see the company make money under standard accounting rules.
Okay, GAAP profitability and SBC, number one risk. What else? We can't ignore that short seller report from late 2024.
No, you can't. That short seller controversy from November 2024 definitely created a reputational overhang. A firm called Culper Research came out with a report alleging some pretty serious stuff.
Like round-tripping revenue.
Yeah, allegations of round-tripping revenue, improper data collection from so-called consent farms. Now, Zeta responded really swiftly and forcefully.
How so?
They pointed out factual errors, provided a detailed rebuttal, even commissioned a forensic accounting review which found no evidence to support the claims.
But the damage was done.
Well, allegations like that tend to cast a long shadow, even if refuted. It's certainly contributed to the negative sentiment and that valuation discount we talked about. It raises questions in investors' minds.
Understandable. Any other major bear points?
Well, there are the broader macroeconomic headwinds. As we noted, even management acknowledged these by issuing conservative guidance. External risks could still impact customer spending down the road.
True, the macro environment is always a factor.
And finally, just the sheer stock volatility. Zeta is known for being a highly volatile stock. It can have sharp price swings, sometimes made worse by speculative trading or options market activity. It's not for the faint of heart.
Right. High growth, high potential, but also high volatility and specific risks. Let's talk about the people running the show. Who's leading Zeta, and how are they tackling these investor concerns head-on, especially the SBC and the fallout from the short report?
Okay, leadership. The company is led by its co-founder, David Steinberg. He's a serial entrepreneur, got a track record of scaling tech businesses.
And John Sculley was involved too, right? From Apple.
He was. John Sculley co-founded Zeta and was vice chairman. He recently transitioned to vice chairman emeritus, so he's still providing some advisory continuity.
Okay. Now that CEO compensation and the overall SBC level, it's clearly a hot button.
Yeah.
You mentioned the $190 million guidance for 2025 SBC. What's management doing about it?
This is absolutely critical for many investors, probably the most critical issue for the bears. So yes, for 2024, the CEO's total comp was over $26 million, mostly stock awards. That's a big chunk of the SBC expense.
$26 million, wow.
And that high level of SBC, as we've said, is the main reason for the gap losses. And it caused significant shareholder dilution, around 15% in 2024.
15% dilution is very high.
It is. But to their credit, management has made a very clear, very public commitment to tackle this directly.
How specifically?
So they guided SBC to $190 million for 2025. While still a big number, it is a decrease as a percentage of revenue. More importantly, though, they've laid out a multi-year plan.
A plan to reduce it further.
Yes, a plan to drastically reduce the dilution from SBC down to the 4-6% range in 2025, and then even further to 3-4% in 2026.
Okay, 3-4% is much more palatable for investors.
Much more standard for a company of this size and growth profile. And they're backing it up with action. They've been actively repurchasing shares. They bought back $25 million worth in Q1 2025 alone.
Share buybacks help offset the dilution.
Exactly. So the successful execution of this dilution reduction plan, honestly, it's probably the single most important promise management has made. It's absolutely key to unlocking a higher valuation and finally achieving that sustainable GAAP profitability. It shows disciplined capital allocation.
That's a huge point.
Yeah.
And what about insider confidence, especially after that short seller attack? Did management put their money where their mouth was?
They did. Corporate insiders already own a decent chunk, about 11.9% of the shares, which shows alignment. But critically, right after that short seller report hit in November 2024,
yes,
CEO Steinberg and several other leaders made a very coordinated, very public purchase of Zeta stock, about $3 million worth altogether.
Buying stock right after the short report?
Exactly. It was a direct financial rebuttal to the claims, a really powerful, tangible signal of their confidence in the business and its future, right when doubts were being cast.
Okay, that is a strong signal. So wrapping this up, if you're one of our listeners, maybe more sophisticated, risk-tolerant investor looking at Zeta Global, what are the absolute key milestones you need to watch? What tells you if management is delivering and unlocking that value?
Yeah, for sure. This isn't a set it and forget it stock. Realizing the potential value here really hinges on management executing on several key fronts. So here's what we'll be watching closely.
Lay it out for us.
First and foremost, quarterly SBC and dilution metrics. Are they hitting those targets? Are they demonstrably reducing total shareholder dilution down towards that 3-4% range by 2026? That's the #1 KPI for improving GAAP profitability and changing investor perception.
Got it. Track the SBC and dilution numbers religiously.
Second, the achievement of GAAP profitability. The very first quarter that Zeta reports a sustained GAAP net profit, not just adjusted, but actual GAAP profit that will be a major inflection point, could trigger a significant re-rating of the stock.
The GAAP profitability milestone.
Crucial. Third, keep an eye on super-scaled customer and ARPU growth. Continued momentum with those big $1 million plus customers and seeing their average spend keep climbing. That validates the whole land and expand model, the stickiness of the ZMP, and especially the value derived from those new AI solutions.
Proof the platform and AI are working and deepening relationships.
Exactly. And finally, #4, M&A activity. Any concrete news about a strategic acquisition, whether Zeta is buying someone or being bought, that would immediately change the whole investment landscape, likely unlocks significant value very quickly.
Okay, SBC reduction, GAAP profit, big customer growth, and M&A buzz. Those are the key catalysts.
Those are the big ones to watch, yes.
So let's go at home. What's the big takeaway for you, the listener, from this deep dive into Zeta Global Holdings? It seems like a really compelling high-growth story.
Driven by powerful AI, consistent execution.
Right, especially that strong monetization they're seeing from the advanced AI offerings. And that Zeta 2028 plan. It paints a clear picture of a very ambitious future built on expanding margins and free cash flow.
Definitely. But if we connect this to the bigger picture, I think the investment thesis really boils down to management's ability to shift the narrative.
Shift from what to what?
From just growth at all costs, which maybe characterized their earlier days, to proving they can achieve profitable, sustainable scale. And the key to that proof is executing flawlessly on that SBC reduction plan and showing that disciplined capital allocation.
So for you, the listener, this is a company with potentially significant upside, right? But it's absolutely not a passive investment.
Not at all.
It demands active monitoring of those key milestones we just hammered home. It's a fantastic real-world example of where cutting-edge innovation bumps up against market skepticism.
And how crucial those management decisions around things like non-cash expenses, like stock comp, can be in shaping how the market ultimately values a company.
The potential reward looks high, but the risks, gap losses, the SBC, the past controversy, the volatility, they're very real and require you to stay diligent.
Absolutely. So as you think about this, consider what parts of this deep dive resonate most with your own investment style and your understanding of tech trends. And maybe reflect on how that gap between adjusted figures and GAAP reality can really impact a stock's journey.
Excellent points. Thank you for joining us on this deep dive into Zeta Global Holdings. We hope you found it useful.
Always a pleasure.
If you did find this valuable, please remember to hit subscribe, give us a like, and turn on those notifications so you don't miss our next deep dive.